Hello and welcome to another video here at FiscalVoyage. I'm Felix, and in today's video we're going to do my top dividend growth stocks with over 100% return. So we're going to go over 5 different companies that generated over 100% return for me in the past few years. And we're going to look at the current valuation at today's price to see if it's still a good buying opportunities of these 5 particular companies. But before we get started with my best dividend stocks, if you're new to the channel, make sure to hit that subscribe button as well as check out my free ebook in the description below. So here's my portfolio, just a brief portion of it. So we're going to look at the top 5 dividend stocks that are generated over 100% for me. As you can see here, Visa 181% growth, Target 172, John Deere or Deere and Company 165%. Norfolk Southern Corp 164%, and Qualcomm 142%. And all of these do not include dividends. This is just the gains, capital gains. They do not include dividends, so it could be slightly higher because of the dividends that I've received from these companies. You can see some of the other ones here, but we're going to just talk about the 5, my top 5 dividend growth companies that generated over 100%. So let's go more in detail these companies and see if their current valuation and price to see if it's a good price to buy now. So the first dividend growth stock is Visa. You can see here Morningstar gives it a 2-star rating. Some of the key ratio, tremendous growth, 15% revenue growth for the past 3 years compounded. Net income growth, outstanding, 26% 3-year compounded. Morningstar gives Visa a fair price of $171 and last closing price at $198 yesterday price. So it looks to be overvalued. Wide moat, excellent. Some of the key financial, debt to equity ratio, very good. Current ratio is good. Price to sell is high, and earnings yield, price to earnings is high as well. So we look at the fast graph for Visa. You can see here the company has been growing earnings very nicely here, over 20% throughout the years. I had an 8% growth in 2016. This year is expected to be down actually by 8%, but picking up nicely by 16% in 2021. Overall, the stock looks to be overvalued at a 40 PE, but because of the fact that the company is growing at a very double-digit rate in the high teens, and you can see here 2020 they're expected about 21% growth. It still, has potential for return, but very low. As you can see here, total annual expected rate of return about 5.1%. So it's not an attractive price right now. You can see here earnings yields at only 2.54. The dividend is very low at 0.6. The S&P credit rating is very good. So the company overall is very solid. It's just the valuation doesn't make sense for me right now. The next stock, dividend growth stock with over 100% return is Target. You can see here revenue has been growing much lower than Visa at 3.97% compounded annually for the past 3 years. Net income double that rate at 6.27. Morningstar gives it a 1-star, which is a sell basically because they have a fair price of about $107 versus yesterday's closing price of $163. So it looks to be overvalued based on Morningstar expectations. If we look at some of the metrics here for the financial health, debt to equity ratio is pretty high at 1.3. Interest coverage very low, or high rather, which is very good at a 10.5. You like to see an interest coverage of about 2.5 or 3 or higher. So that's really good. Price to sell is decent at 0.98, so that's positive. Price to earnings is high here. But if we look at the fast graph for Target, you can see here there's been some down years for Target, 27% loss in 2014, 6% loss in 2018. But recently, you can see here 14%, 19%, and this year they're expected to grow 13% growth. So this is what's been driving the share price for Target because of these growth to this high of PE around 23 based on fast graph. You can see here earnings yield at 4.29. Current dividend yield 1.67. That's much higher or lower versus the 5-year average. But however, the company itself is a very good company. S&P credit rating of A. Long-term debt to cap is decent at 56. I like to see this under 50. But overall, solid company. You can see here earnings are still expected to grow, but the valuation does look high based on this normal multiple of 15.5. So you could potentially, if you were to buy now, you could potentially lose money or have very little rate of return. So right now, me personally, I'm just holding Target and Visa at current prices. So let's look at the third one. So the third company with over 100% return is Deere and Company, ticker symbol DE. You can see here Morningstar gives it a 2-star rating. If we look at the key ratio, revenue growth has been growing outstanding, 13.9% for the past 3 years compounded, and net income growth 28.76% for the past 3 years. However, it is slightly overvalued. You can see here, last closing price $236, and the fair price for Morningstar is $183. It does have a wide moat, so that's positive there. Some of the metrics here, debt to equity is high at 3.76 because this is a very capital intensive business, and in the industry with the tractors and all the equipment and stuff like that. Price to sales at 2.12 and price to earnings is high at 27. Current ratio is good at 2.22. This is basically current asset divided by current liability. So if we look at the fast graph for John Deere, you can see here John Deere is a very cyclical company. You can see here earnings do drop. There's years where earnings drop over here. In 2014, 2015, and 2016, there was 3 straight years of negative earnings, negative 5%, negative 33%, negative 17%. So that's what's really was causing the price to really, don't go anywhere. But in 2017, it had a 40% increase in earning. 2018, 41% increase. So that drove the price higher. Again, this is why earnings is so important to look at, because price follows earnings. As long as earnings is growing, price will eventually follow. So even though it was flat more or less for 3-4 years, because of the fact that earnings did grow, but it was people were expecting it to come down, but it didn't go anywhere. But once it started to pick up, that's when the price really shot off. And you can see here it shot off way in a lot more with a P of 30 or 31. Dividend yield is very low at 1.29. However, the company is a very solid company. You can see here adjusted earnings covers the dividend very nicely. But because of this high increase in price, you could have an expected, negative 8.8% annual rate of return for the next 2 years because of the high valuation. So this is why valuation is so important. So for me personally, I'm just continue to hold Deere and continue to collect the dividend and invest it elsewhere. So the fourth company, Norfolk Southern Corp, the next dividend growth company that helped generate over 100% return for me. Morningstar gives it a 2-star rating. Revenue growth has been slow at 4.5 compared to some of the other ones that I've just talked about. But net income grew very nicely at 17.7 for the past 3 years. Has a wide moat. Currently, Morningstar has a fair value price of $177. Last close, yesterday's price, $1,212. So it means it's overvalued, and this is why Morningstar gives it a 2-star rating. So look at some of the financial. Debt to equity ratio is very good at 0.8. I like to see this at 1.2 and much lower. So that's a good debt to equity ratio. Interest coverage is good, 5.3. Like I said, I like to see this 2 or 2.5 and higher. And current ratio at 1.2, so that's decent current ratio. But if we look at the fast graph, you can see here, again, this is another cyclical type company where earnings drop. There's years of earnings loss. You can see here in 2015 it dropped 20%. This is when I actually bought shares, because that's when you like to buy companies when there's bad news, because that's where you really make money, and because the price dropped. And you can see here the price jumped tremendously since then, because they were back growing earnings 10%, 18%, 44% in 2018, 8% in 2019. This year they're expected to be down. Not sure why the price has gone up because of it, but at current prices it does look to be slightly overvalued. It looks like you could make a decent profit, not too much. A total annual rate of return about 3.5% for the next few years. Me personally, I'm going to continue to hold this company. It's a solid company. You can see the dividend is very well covered based on adjusted operating earnings. Earnings yield of 4.3, that's low versus my criteria of 6.5 or 7. triple B plus credit rating, so it's investment grade. Good long-term debt to cap ratio, but overall the valuation is what I'm not liking right now. And last but not least, Qualcomm, ticker symbol QCOM. Morningstar gives it a 2-star rating. If you look at the key ratio, the revenue has been basically flat, 1% growth over the past 3 years. Net income, they've lost negative 8.39. Not sure exactly why the price is going up, but because of the 5G, infrastructure and people, looking at 5G as the next growth catalyst. It has a narrow moat. Morningstar gives it a fair price, about $90. Last close of $128. Debt to equity ratio is high at 4.8, but they make enough money to cover the interest coverage of 6.17. Current ratio is good at almost 2. Price to sell looks pretty high, and price to earnings is high. So if we look at Qualcomm, you can see here from 2014 all the way to 2019, the company earnings was down 12%, 5%, 4%, negative 14%, negative 4%. And just recently, they're expected to grow earnings for 2020 by 11%. But this is what I'm talking about. This is what drove really the price. 2021 and 2022, you can see here, 2021, they're expected to grow 66%. So this is what really jumped the price here, is for the future expectations. But if we shorten this time period, you can see the green dots represents my buying position. Right now, it looks to be slightly overvalued to fairly valued for this company. I personally wouldn't buy shares right now. Earnings yield of only 3.16, low dividend, 2.02, but solid company. Negative A or A minus credit rating, which is investment grade. Again, the high debt to cap ratio, we saw that in the debt to equity ratio was high, but overall they're able to coverage the interest. You can see the earnings growth is coming, 66% in 2021 and 15% in 2022, after they've been lower or losing earnings in the past 3 to 4 years. So, but right now I think the company is overvalued, and personally I'm not buying, and I'm just going to continue hold it and recollect the dividends and invest it elsewhere. So those were my 5 best dividend stocks. As you saw, I had a few other more that generated 100%, 80%, 90%. But overall, I just wanted to talk about my top 5 companies. All of these 5 companies are great companies. I'm going to continue holding these companies because I think the valuation is kind of high at current price. So I would definitely buy more shares if the valuation came more reasonable. So thank you for watching my best dividend stocks that generated over 100%. Again, if you're new to the channel, make sure to hit that subscribe button, as well as check out my free ebook in the description below, and I'll see you guys in the next one.